think we were right to wait and see how tariffs and inflation and the labor market evolved. There wasn't widespread support at all for a 50 basis point cut today. I think you could think of this in a way as a risk management cut.
Fed Chair Jay Powell there speaking after a widely expected quarter rate cut there, while dampening hopes of bigger reduction. We're just half an hour away from the open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. U.S. futures equities across the region mostly on the up. The dollar's bouncing back after the Fed decision. Powell, as we just heard there, of course, keeping policymakers largely united despite President Trump's pressure for a larger cut.
Indonesia's central bank, meanwhile, backing President Prabowo's growth push after widespread protests and delivering a surprise rate cut.
And China making this fresh move to wean itself off Nvidia hardware, telling companies to stop buying a chip that can be used for AI. Welcome to the show and good morning. The emerging narrative, and I have to hedge this because we're just a few hours divorced from the Fed decision, is that you wouldn't have known there was a Fed decision, of course. Like looking at how uneventful pricing was, with the exception, I guess, of the wobble in the U.S. dollar. It speaks to really how well telegraphed this move was. And again, equity markets seem to be continuing what they were doing a day ago, 2 days ago, 3 days ago, with the exception, I guess, of a pullback across some parts of the equity market. In fact, when you flip the boards, please, and have a look at the dollar, we'll get to the China story in a moment there. You look at what happened overnight, likes of Baidu. Again, it didn't seem like there was a Fed decision to contend with as far as the Chinese equity complex is concerned. Now, when you look at the dollar itself, not as clean a read as one would expect, because you do have, of course, this aberration coming through in the form of a very weak Kiwi dollar. In fact, you look at this, you look at the Aussie-Kiwi cross, you look at this drop in the two-year yields with this 50 basis point cut now expected. Change the page, please. Out of the RBNZ, Westpac coming out with an updated forecast, and that just because the GDP print there just missed completely everything. All the estimates, 2s and 10s, the curves on your screens, slightly flatter on your screens. Now, are we then moving into this phase, I guess, that's the key question here. After weeks of steepening, week and a half ago, of course, this move towards the flatter side of things, does this continue moving forward? And do we even talk about 4% at this point, or do we need to wait for more data points ahead? Right, very quickly, as promised, the Golden Dragon Index, Baidu, Alibaba, and Neo. Trip.com, my mistake, on your screens right now. We'll be speaking with Xiangshan later on, of course, here on Bloomberg Television, and certainly the story there is, well, the company was summoned by Zhengzhou officials. We'll talk more about this in terms of pricing. Their Golden Dragon Index and momentum coming through and continuing going into the open today with futures. And, of course, we're looking at one specific level, excuse me, on dollar onshore, which is right at about this level, which was the low we hit back in November of last year. Below that, we're back to levels in October of 2024. We'll talk more about that in a moment. And, of course, almost like clockwork, Fed cuts. HKMA has also cut their interest rate. Yvonne.
Yeah, certainly not a surprise there, but certainly we'll see what this rally brings here today. You mentioned some of these ADRs. Certainly does suggest that we could see continuously this tech rally. And we're talking about a little bit more of the valuations, right, between HS Tech and NASDAQ, actually getting a little bit closer there as well. Stocks, as we talked about, Trip.com, given what we've been hearing there. Baidu certainly is the standout from yesterday as well. We see another day of this as well. Chips, Hong Kong property. Of course, we got that policy agenda. There was talk about the Northern Metropolis delight there. Not much when it comes to property connect, though. And China-Australia talks to tell you about as well. Watching 710 for dollar China. It looks like, given what we saw with the Fed and the like, maybe that sort of level is not too far off now. And that China Defense Forum, which we are starting to hear some lines here right now from the Defense Minister, Dong Jun, speaking at the Xiangshan Forum and saying basically, as they kick off the event there, that China, we do not intend to overturn the existing order. This is, of course, a three-day event there. There's going to be a lot of sort of high-profile diplomacy in these next weeks. And it's really what we've been seeing from China, right? Whether it was the SCO, the military parade just a few weeks ago as well. So I think there's more than 100 defense officials that are at this event this morning. But so that's what we're seeing, live pictures there in Beijing right now. Let's talk a little bit more about what's going on. It really is that what I heard from the Fed, right? It's a risk management move, right? It's interesting how the market reacted, right? As you mentioned, it's almost like nothing happened. But it was a cut, and we initially saw a bit of a dovish reaction.
Yeah.
But as soon as you started speaking about, it's a risk management, AKA, I guess you say, insurance cut in some ways. And we're back to almost being very data dependent now moving forward from the Fed. So maybe the path forward in this easing cycle still not that clear.
Yeah, the path is slower, but the timing is not as straightforward.
Yeah.
It also didn't mean we actually didn't get the dissenting votes coming through.
Yes, solidarity
out of the other two,
see.
with the exception, of course, of Mr. Myron. And that then speaks into, I guess, the inability to form a consensus, even with, of course, the White House's preferred monetary policy members, as far as that's concerned. Now, the other thing, though, that while we did not get that policy, that sort of dissenting split, just the whole range of policy views on where the economy will be, in effect, is also a dissenting vote, right?
Yeah.
So it's very, very difficult to then formulate a strategy at this point in time. To Powell's point, right, it's hard to gauge what to do next.
Yeah.
And I think you can use that as far as the market goes. The other thing we want to talk about, Suze, apart from the Fed, we'll go to that later on as well, is on the Nvidia story, which we did close lower on the shares of Nvidia. And it does seem this might actually add a further push to this AI story in China.
It adds to the whole self-sufficiency sort of theme, right? That we've reached that inflection point. First, it was just rhetoric of government, trying to urge the industry to kind of catch up. I think now we're starting to see signs of that catch-up is now underway.
Yeah.
And that AI monetization is actually happening right now. So I think when the likes of Capricorn, some of these chip players, probably will bode well here today. We'll see on this Nvidia news. But certainly there's going to be a lot of talk about where to next on the whole China tech rally, too.
I'm actually looking, so that's why I'm ruffling through my notes here.
Your pile of notes.
I promise I'm not ignoring you. On that story, right, so yesterday the Alibaba story around its big client China Unicom is did go fly under the radar quite a bit, but it underscores the self-sufficiency push that's really led to now we're starting to see this re-rating in the markets around AI, right? So we're actually getting tangible examples of how that's actually playing out. But anyway, of course, that's just to say, of course, we're looking at tech AI rally, and this Baidu rally, of course, that's taking place. Will be one of the stocks we'll be tracking going into the open today.
And Meituan as well. We have Macquarie's Ellie Jiang joining us to talk about that. They still have the lowest price target on the street when it comes.
75.
Yeah. All right. Let's talk a bit more about the Fed. Chair Jay Powell there pointing to signs of weakness to the labor market to explain why officials decided it was time to cut rates.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Joining us now is Jack McIntyre, Portfolio Manager at Brandywine Global. Jack, good morning from the Asia Pacific. You guys have done extremely well, so congratulations on that. What I want to figure out now is what I do with everything that Jay Powell said there. We throw it into a blender. What comes out and what stood out to me, maybe, he didn't mention it, is perhaps the concept of stagflation. How are you looking at where we go from here as far as rates go now?
So, David, I think it was a very appropriate sort of FOMC messaging all around. I wish the only thing I wish you probably would have fleshed out that risk management concept a little bit, because if you think about it, we know monetary policy works with a lag. But then, everything around the labor market works with a lag too. So, if you're all cautious about the labor market, and clearly they are, it was very much peppered weakness in the labor market or softening. So they needed to do something, and real policy rates are real restrictive. Having said that, though, coming out of the meeting, it's not like I really want to make big structural changes to our portfolios. It's a kind of a wait and see, and you're absolutely right in the sense that we are now all, including the Fed, back to being data dependent. important. We've got to see that direction of, what's more important for overall financial markets. Is it the inflationary aspect, or is it the slowing labor market? I lean towards the slowing labor market. But yeah, we're not making major changes or probably really minor changes based on this Fed meeting.
The focus on the labor market, do you think that was dovish enough and matched what market expectations are? I feel like there's still a bit of a gap there, Jack. Do you think that terminal rate essentially has to be repriced higher now?
It needs to be. It does need to be repriced a little bit higher. But we've got to kind of sort of wait and see. We've got a long time till we get that. I think it's also just more of the timing of the path on how we get to that terminal rate. But again, that's why I don't want to be overly dovish on here, because we are in a stagflationary world. But having said that, if the labor market does weaken, and again, I'm not looking for a recession. I think it's just going to be this sort of slow, steady decline. I'm actually going to be fascinated in the U.S. Thursday morning to see the initial jobless claims. Last week we saw a little uptick. I think it can be explained away by developments in Texas. But if it's not, then that's a sign of, hey, the demand side is starting to weaken. Because right now, we're focused more on the sort of the labor, the supply of labor being more of a drag. But if it ultimately flows through to the demand side weakening, then you're going to see even lower rates across the curve.
Is that it? Okay, so have yields on the long end peaked, Jack? In other words, do we get a flatter curve from here?
Well, to get a flatter curve, we have to see a little bit more reach for duration. We've been actually nibbling a little bit more on the longer dated maturities. It's very much the 30-year is a very much unloved part of the curve. I get it because of the fact that, hey, there's a risk, and again, I got to look at both sides. A year ago, we got a similar message from Powell, and yet they cut into an economy that actually was still doing well. So that was not a great environment in Q4 for Treasury. So I'm not pounding the table saying that this is the move that gets 10-year Treasury yields immediately down to 3.5. But I think we're probably fleshing out a new range for next year. Maybe it's at 3.5 on the floor and 4.5 on the upside. Remember, I'd be more confident in really loading up on more duration on weakness, because we know the administration wants lower long end rates. They kind of reminded that the Fed's third sort of mandate is sort of stable rates in the long end of the curve, and we know Scott Bessent really wants that, and it's part of their overall plan. So you're going to see some more creative things unfold if we get a backup in 10-year yields. Having said that, we're not positioned. That's not our base case, but we'd be more inclined to be thinking about adding duration in that scenario.
Yeah, can you tell us more? I'm still trying to wrap my head around this third mandate of moderate long-term interest rates. Yeah. Jack, is that essentially yield curve control?
I think it actually does speak to yield curve control. The Fed is not going to lead with that sort of concept. Again, it's not. There's precedent. The whole idea of QE and now QT. The Fed does have other tools to influence the shape of the yield curve. Because part of this, Yvonne, is that, and again, we've got to be careful, but in a world where we have this much debt and yields move higher, how do we go about funding all of that debt? It's a slippery slope. So we've got to think outside the box. Again, this is not base case, but I'm just saying you've got to be open to the idea that, hey, it could be down the road that they have to do yield curve control to sort of be able to kind of sort of finance that huge amount of debt that we've been spending for the decades.
Jack, let's look at Q4. Underweight dollar, does that continue to bear fruit?
I think it does, David. I think it's a higher conviction trade. Bonds have actually been in a range now for several years, but I think, and we've done, in terms of our performance, we've had a bigger positive influence on being underweight the U.S. dollar this year, and I think this is a multi-year sort of development. I think it's a relative growth dynamic. You think about what got us to part of that American exceptionalism. Is that, hey, our government spent a lot more money than others. Now there's maybe a little bit of a day of reckoning. The tariff revenue, which is a tax on consumption, I think it's a good thing, but remember, it's a fiscal drag. So that's going to, at the margins, slow down the economy. You've already started to see it for non-asset owning consumers in the U.S. And I do think migration is a net drag on economic activity as well. So other parts of the world are actually embracing a little bit more fiscal stimulus. They're embracing less regulation. So I think, yeah, we are starting to see what I could be a 5-year back end of this decade sort of shift in relative growth, where some version at the margins of American exceptionalism diminishes. We know non-U.S. investors, foreign investors, are loaded to the gills with U.S. assets. I think we're going to start to see a little bit of a shift in that, again, at the margins, and that's what influences price. In this case, the price of the dollar.
Yeah, you've been kind of saying you're in and out of local currency EM bonds right now. Some of the high yielders are right there. What's the positioning around that now?
So we still like LATAM. So we're still long Mexican and bonos, Mexican bonds, Brazilian bonds. We like the fact those real yields are still high. So inflation-adjusted yields are high. You know, what's interesting, Yvonne, is that, you know, and you see what's going on in France and elsewhere. There's just too much debt at the federal government level. You know, EM has gotten their out, and again, I'm being generic. A lot of countries have gotten their house in order. You go back to the taper tantrum in 2013, and we saw this sort of shift towards, you know, away from current account deficits to current account surpluses. So again, it's just longer term, bigger picture. It might be time for EM assets to kind of to do better. But again, I got to hedge myself. EM is not homogeneous. You've got to be country specific.
Yeah. Yeah. All right, Jack, always great to have you. Jack McIntyre there, portfolio manager at Brandywine Global. Coming up, China is set to have told domestic companies to stop buying an Nvidia chip. We have the details coming up. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. All right, we're taking the chips here right now, obviously on the back of that Fed rate cut. And then, of course, this Nvidia story and our sources also saying that China is telling companies to stop buying Nvidia chips with AI uses. So you are seeing the likes of SK Hynix surging again, some 5% in South Korea. And we'll talk a little bit more about that, right? How they're widening this clampdown on Nvidia in China and instructing domestic companies to halt orders for a particular workstation chip that can be repurposed for AI uses. For the latest, let's get to our chief North Asia correspondent here. Stephen, you know, it's interesting. We're not talking about H20 chips at all. Yeah.
Which is actually a higher processing AI accelerator to this RTX Pro 6000D. They need to get a smaller name for that, but that's the one we're talking about. You're absolutely right. It's used mostly for workstations and lower-end AI uses, but it can be repurposed, and it has been repurposed in China. So what we're hearing from sources is that the Cyberspace Administration is essentially informing and instructing Chinese firms to stop testing those RTX Pro 6000D, as well as cancel existing orders. Now, there's a number of ways to read into this. Obviously, there have been a number of moves, including from Ministry of Commerce, for investigations into America's restrictions of export of advanced AI chips that was launched in the last few days, as well as that's an anti-discrimination probe, as well as an anti-dumping probe against U.S.-made IC chips, analog IC chips. So there's been a number of moves, as well as a ruling, I hear, on Nvidia, essentially comes as this anti-monopoly laws, basically reprimanding about this $7 billion deal back in 2020 that Nvidia made into Mellanox technology. So there's been a number of steps that China has taken. Now, is this because they have overconfidence and confidence in the domestic industry for AI chips? We had that story as well late yesterday with Alibaba saying it secured a large-scale customer in China, Unicom, for its T-head AI accelerator. Maybe they're seeing the domestic industry filling that gap of the lower-end AI chips that they were buying from Nvidia, or this is bargaining chips ahead amidst talks between the U.S. and China.
Yeah, how likelihood is that for this to feature? Because there is that phone call still.
Yeah,
to
that's
be
coming
had
up
later
on
this
Friday.
week, yeah.
I think everyone's trying to get some leverage ahead of any kind of meeting that could be planned for Donald Trump and Xi Jinping, and who's going to have the deliverables. Obviously, TikTok's in the mix right now. The chip industry is in the mix right now. The rare earth and magnets is all in play as well. So I would not discount that. Now, is China, by doing this with the RTX Pro 6000D, limiting that? Are they putting themselves at a technological disadvantage? Well, Bloomberg Intelligence put out its analysis. They said this is more of a political signal than a technical sacrifice on part of China. So it's leverage. It's a bargaining chip. Now, a number of reporters did catch up with Jensen Huang, who's on that trade mission to the UK with Donald Trump. He was asked about this, and we do have a quote. We can bring it up. He says, "I'm disappointed in what I see, but they," meaning China, "have larger agendas to work out between China and the United States. We can only be in service of a market if the country wants us to be there." So we'll have to see how this one plays out, but it could be all resolved by a phone call and then a meeting, or maybe this is a longer-term trend in China's belief that its domestic industry has made significant ground.
Steve, fantastic. Thank you so much. Stephen Engel, our Chief North Asia Correspondent. Really just on that last idea coming out of Steve there, this idea of self-sufficiency, the future of Chinese tech, AI, this return of Jack Ma and Alibaba. So in a couple of minutes, we'll be hosting, of course, this live Q&A, and some of our colleagues, of course, Annabelle Jewelers, of course, our colleague, will also be joining that as well. So subscribers, by the way, can join that conversation, quite literally get your questions in, get your comments in via the website, Bloomberg.com. Right, welcome back. The approach to the Open is not very consistent, so I'm not going to say anything and just leave that there. Lots of other things to talk about anyway.
Yeah, I mean, it's interesting. We have a report from Goldman Sachs, Kendra Lau. They're saying, look, investors should embrace a buy on dip mindset when looking at Chinese equities now, as valuations right now still not looking too stretched according to their minds as well. So in terms of analyst actions, what to look ahead to, China Wanka A shares has cut to add at Orient Securities. The Hua Hong Semi is an interesting call from Goldman. So they're upgrading the stock here to a buy from neutral, increasing its price target as well, saying AI power and selling price enhancement will drive growth ahead. The stock up some 3% here this morning.
Yeah, there's a difference in terms of the implied jump from 55 to the mid-60s there. Right, looking at Baidu, Sense Time, some of the big winners in yesterday's session. JD.com also that move up overnight. And Baidu continues that rally. We're up a further 3% this Thursday. The Open is next. This is Bloomberg. Good morning. And so in terms of the quick weather update, it's hot and humid out there. There's a typhoon and approach to Hong Kong. I think there's a separate one coming next week. As far as markets go, the clouds in the Fed conversation might have parted ever so slightly, at least up until the next meeting. Then we have to over-obsess again over what that meeting will be, the data points, of course, around that. But it's as if, Yvonne, we were joking about this early on, it's as if the Fed meeting did not happen, and it's, markets are just continuing with the many themes that they have been latched onto in the last few days.
I mean, case in point, China tech, right? Even before this Fed meeting, it was still bucking everything else out there. When everyone was taking a pause, China tech still had some reason to rally here as well. And it really kind of coincides with what we're hearing from the likes of Goldman Sachs with this latest report talking about, look, you should really embrace this whole buy the dip mentality because for the most part, valuations are not stretched right now. And they mentioned there's still that potential for allocation from households. Everyone's talking about these savings that need to be deployed. So certainly they say there is reason, and they say this slow bull market that has been more constructed and constructive than years past here, because you are getting that anchored liquidity sponsor, they say, and really long duration capital that is actually maybe supporting this market. So there you go. And when it comes to signs of overheating, they say we're nowhere near the levels that we saw back in 2015. So that's the call from Goldman Sachs here today. We are seeing a little bit of retreat when it comes to onshore markets here. And what we're seeing when it comes to government bond yields, looks like it's taking higher for the 30-year bond, just slightly here at 216, 217 levels as well. But really, we're watching very closely what happens in Hong Kong, because that is really a lot of where the price action is right now, given what's going on in the tech space. We talk about Alibaba securing that deal with China Unicom. That certainly did lift a lot of the sentiment there yesterday. And there you go. Alibaba is still extending that rally, or up about 0.6% here. Meituan is unchanged, though we have seen it actually rallying alongside China Tech, given this was probably one of the laggards within that space here as well. But then yesterday there was JD.com's chairman talking about they don't want to participate in price wars when it comes to hotel prices as well. Might that be a sign that maybe things are easing up when it comes to the price war among some of these companies, or not? We'll see. We're certainly one to watch there here today as well. So it looks like HS Tech is catching a bid here this morning, 710 levels when it comes to dollar China. And we'll watch, of course, honky dollar. We did also, HKMA follow with that rate cut, along with the Fed, 777 for dollar honky here right now. In terms of what we're watching in terms of the chips, certainly that Nvidia story. So our sources, along with the FT, also reporting on this, that China has basically banned the Nvidia chip with AI use. So what does this mean for Nvidia's prospects of entering back into this market, right? Certainly, as Steve mentioned, this could be just posturing at this point, but even when you talk to some of the sell-side analysts, they say, yes, this boosts the whole self-sufficiency sort of theme, but then again, it also might actually impact AI development for some companies as well. So right now, though, the consensus seems to be that it is going to help homegrown tech here right now. Capricorn, take a look at that. We're up 3% for Capricorn, Hua Hong Semi, and Haigon, and Hua Hong just getting the upgrade from Goldman too there. So take a look when it comes to Trip.com. So this is the latest there. So the company has been summoned by China's Zhengzhou government there when it came to unfair practices. So we'll flesh this out a little bit more. I think it's potentially due to the whole competition among some of these travel websites as well. So certainly that's one to watch. The stock just slightly down this morning.
Yeah, and of course, Meituan also continuing to rally too. So they do have some presence within the travel and leisure space. Yes. And interestingly, to the point that Yvonne was just making there on JD.com, right? So in about an hour from now, we'll be having, I'll talk more about the chart in a moment here. Ellie Jiang out of Macquarie will be coming on the shows. They actually have the lowest price target on Meituan on the street. It's literally half the consensus. They think actually we fall back to 75. We'll flesh it out even further. Or has news in the last 48 hours changed some of the consensus there? Right. Now, this melt-up we've seen in the tech space in China. So this re-rating that's taking place, what you're looking at on your screens is effectively 12-month forward PE, NASDAQ, and the Hang Seng Tech. And as you can see, the Dave Matthews song, the space between has narrowed substantially between the two. This melt-up in equity markets, as Yvonne was just pointing out, right? Kindra Lau and the Goldman Sachs team basically say it's still fair value, not too expensive at this point in time, Chinese equities. Let's get a sense right now. Out of the buy side, Aberdeen Investments joins us right now. Nicholas Yeo, head of China Equities, with us here on set. Good morning, sir. Very nice to see you. It's been about a year.
Almost a year.
Yeah,
well, thanks for having me again.
A lot has changed in a year.
That's right, yes.
How are you looking at this rally at this point in time now? What kind of questions are you grappling with?
I think on the way here, I was thinking, what's the best way to describe this bull market, right? Is dissimilar to last year when you had like a raging bull. So perhaps I could borrow something, a phrase from my Chinese colleagues, or mainland Chinese colleagues.
Sure.
She was saying that this is more like a water buffalo.
Yeah.
Meaning that it's liquidity driven.
Yeah.
Because there's a divergence between, I know I don't talk about tech for now, but if you look at the fundamentals, the economy and the stock market, there is a divergence. And is this going to last? I mean, we have seen it before as well, right? Liquidity driven rally can last for some time in China. So it's very hard to predict. And I think we mentioned as well that the stock market capitalization as a percentage of household deposit is still 0.6. Imagine a little bit of that trickling into the stock market. That could definitely push up the devaluation or the stock market from here. You mentioned about certain signs of bubble. I don't think we see it yet. Valuation is still reasonable. But having said that, you could say that it's similar to the US, whereby directionally it's correct to be bullish about AI, but the market tends to run ahead of itself, right? So there will be some stocks that probably has factored in too much. I cannot go into individual stock, but there is the similarity with the US, whereby AI is hot and there could be overrun or running too hard in some names. Yeah.
People say what's missing is still the earnings upgrades, right? Is that still going to be a constraint for any kind of valuation upside in this market?
I think at some point, I mentioned about this being more of a water buffalo, which is good. That means it's not a raging bull.
Yeah.
It's slower, so there's time for it to catch up. The retail money hasn't piled in yet.
Yeah.
So there's time given for companies' earnings to catch up. You could say that China, you can divide into the old and the new. The old economy, you're still seeing very depressed earnings. That will probably need more support from the government in terms of confidence. But then on the other hand, you have the 20% of the economy you could say is more innovation related or tech related.
Yeah.
That we have seen actually quite good numbers already. Selectively, not all names.
Yeah.
So we look at the AI supply chain. Some names we're looking at those names that have earnings track record, and those companies are able to report quite good earnings growth. So those are the ones that are backed by fundamentals as well, and not just driven by liquidity. Yes, there's some liquidity-driven rally, but at the same time, we want to stick with names in the tech as well, whereby there is earning support. You're seeing that coming through. So it's an interesting market whereby not everything is rosy. It is not a typical bull market. You have to be very selective as well, and certain segment of the market is still doing okay, and it's worth having a look.
I mean, you mentioned liquidity, and I like the statistic you mentioned here. $1 trillion so far across the Stock Connect coming into Hong Kong. A lot of that has gone into the usual names. I mean, you just simply have to look at the Hong Kong Exchange website to figure out where that money is going. So my question is, now with tech, AI, and let's call them growth names at the forefront of people's investors' minds, what happens to other style factors, dividends, value? How are you looking at what seemingly become an unloved part of the equity, relatively unloved part of the equity market?
I think one of the main fund flows coming into Hong Kong, I think it's still the case. It's not just the growthy style type of funds, but also the insurance, the long
income,
patient money, if you like to put it that way, income-seeking insurance funds. I don't think they're going away, given the interest rate may trend further down from here.
Okay.
There's always a possibility, especially with the Fed cutting rate overnight, that there's room for China to cut rate as well at some point. And hence, there's a need to look for higher yield. So there's still a place for some of the high-yielding stocks. It could be in financial, it could be in non-financials. So I think there is still a room for that.
It's not zero-sum.
It's not zero-sum. And some of the consumer names, I know it has to be unloved. These are more the traditional consumer names. I'm not talking about the new consumer names, but the old consumer names. That they could provide value as well if we have more policy coming through in the fourth quarter, which is likely to be a policy-heavy or intensive quarter. So there could be more support on the service side, and we heard that yesterday as well.
Yeah.
And that should help. You could say the more traditional type of consumption. Yeah.
You also think there's more maybe opportunities in the A-share market here, and potential for sustained performance. What are you seeing in the A-share market in particular in terms of opportunities?
I think we are still bottom up, so it doesn't matter whether it is A-share listed or H-share listed. I mean, more and more of them are coming to H anyway.
Yeah.
So I think we're looking for a company that still offers the share class that still offers the discount. I mean, that's the most straightforward way of investing in them. But of course, in the A share market, you have, I don't like to go into, anti-involution. You get some support in the traditional material space, whereby there could be, supply cut at some point. That should support the A share, and as well as, increased consolidation as well with this anti-involution. So you get more of that traditional names in the A share, and at the same time, I mentioned about AI supply chain, right? AI infrastructure. You do get quite a lot of that, and semiconductors more in the A share space. But then you do get some interesting names as well in Hong Kong. So I think it is difficult to say that just go to H, don't go to A. If you look at the innovation, you can find on both sides, A and H. So I think our advice is to go for names rather than go for which share class. Yeah.
So like a well balanced breakfast buffet. Right? There's no need to just stick to the egg station.
Thank you. Yeah.
You mentioned policy heavy will be the theme of the fourth quarter. Just help us understand what specifically you're looking at there, because there are many things on the calendar we can see, including the World Conference, of course, which I think is in December, of course.
Yes.
Yeah.
I think the FIRE plan is the 15th FIRE plan is what investors should be looking at, especially if you're a long-term investor. Apart from the traditional, innovation, support for technology, localization, so that will remain. However, there will be more emphasis on, the service side as well as elderly home, elderly cares. So those are the areas whereby it is worth having a look as well. This will fall into more of the traditional economy, and I think the insurance, life or non-life, falls into that as well.
That's right.
And people tend to forget that, there is still not enough coverage as of today. And as people age, the need for private medical coverage will just be, the demand will just be increasing over time. So there will be more support, you can say, in the FIRE plan into such areas. I think we are not really, we are actually running out of time, and the population is aging rapidly. So we need to roll out some of these as quickly as possible. Of course, there's also the parenting subsidy and all that, which I've heard many times. So I think there'll be probably more emphasis on that side,
Nicholas, thank you. Nicholas Yeo there, Head of China Equities at Aberdeen Investments. Coming up, Macquarie Capital's Ellie Jiang joins us with insights on the tech rally here in China, and also talking a little bit more about Meituan in particular. She holds the lowest price target on the street for that stock in particular. And we're also checking Trip.com shares slightly down to here this morning, of course, after the firm was summoned by Zhengzhou's market regulator over alleged violation of e-commerce laws.
Yeah, in fact, we have perhaps the perfect person to talk us through the potential implications of that. The CEO herself will be joining us. Trip.com Jane Sun joins Bloomberg Television in a couple of hours. Of course, she joins Has at the Times, coming up on your screens very shortly. Plenty more ahead here on, not Ellie, of course, Jane Sun, of course, is the separate voice we'll be having here. There we go. Thank you so much. 11:15 Hong Kong time. This is The China Show.
I think Powell said it pretty well. I mean, he said basically we think that the risks on the unemployment side have risen more than the risks on the inflation side. And so given that, we should be less restrictive.
Given that inflation is still pretty high, I think it's going to be difficult to have a really aggressive rate cut at this stage of the game, even though the labor market's showing signs of deterioration.
The impact of the revisions on the data. He kind of focused on it and then said, well, it's not just that, but then he went back to it again and again. And so that was the first takeaway, is this labor market slowdown has clearly resonated. It's shifted the balance of risks.
Given the information we have on the job market and the revisions, quite dramatic, the Fed has some catching up to do.
Yeah, some of the guest reaction coming through after the quarter point cuts out of the Feds. Take a look at really how the dollar reacted overnight, that swivel into the upside, into where we are right now. So we're back at 11.92, 11 above 11.90 here on the Bloomberg Dollar Index. You can really blame, I guess, to a large extent, that weakness coming through in the Kiwi. That's a separate story altogether, of course. In focus, of course, is EM, and of course, when you look at the Chinese currency, where we are at these current levels here, Yvonne.
Yeah, so a little bit of that recovery in the dollar after that press briefing here. It was a bit of a whipsaw. That's why you are seeing, in some cases, EMFX is slightly weakening here this morning. Certainly, the Kiwi dollar is a standout there, just given those GDP numbers as well. But for more, let's bring in our EM macro strategist, Marcus Wong. He joins us now from Singapore. Let's talk about the renminbi, Marcus, because analysts have been talking about this sort of new range, right? Like 7 to 710 levels possibly for dollar China now. I mean, those are levels where you start to see this increase in conversion of offshore dollar holdings into the renminbi. How big is that expected impact?
Yeah, I think this has been a view that has been quite out in the market that has accelerated, especially since after April 2nd, the whole de-dollarization theme, and of course the impact of this conversion of these offshore dollar holdings that have accumulated over the past decade or so, and this is especially true in China. And I think this view has taken, in a sense of momentum recently, with the PBOC seem to be guiding the Yuan stronger as a result. So some analysts are actually expecting, as much as $300 billion worth of offshore holdings that could be converted back into the Yuan, and this could essentially, be quite a boost. And I think not so much for Yuan, but if you look at this is a theme that is also present in other markets, because for a lot of economies in Asia, these are current account surplus economies. So at the point, over the past decade or so, when the dollar was rallying, when US rates were high, investors were parking their cash into dollars. So now, not just in China, but in other economies such as Taiwan and Malaysia, these analysts are viewing that the continuous slide in the dollar could see a conversion of these offshore dollar deposits. And especially in currencies such as Taiwan dollar, we saw, especially in early May, the magnitude and power of the conversion and the impact of this conversion of the exported dollar holdings that can have the impact on the currency. So similarly in Malaysia, we could see a result. We could see the impact if exporters further convert their offshore dollar holdings.
Well, let's stay in Southeast Asia. We were expecting somewhat of a surprise around the Fed, maybe around the voting split. That we didn't get that. The surprise we got was actually out of Indonesia, and that cut. I think only 2 out of the many economies actually saw that one coming. What do you think day 2 looks like after that surprise cut out of BI, Marcus?
Yeah, well, I think all I can say is that, I'm just looking at the numbers first, right? I think since September 8th, when Mulyani was removed as finance minister, the rupiah is actually the worst performing EM currency globally after the Argentina peso as well as the ruble. So investors have been really nervy over how, the fiscal guardrails around Indonesia as well as the independence of Bank Indonesia. I think it was very noteworthy at the the rate decision yesterday, the amount of focus that Perry Wajio emphasized on growth, i.e. that it's just not just a rate cut yesterday, but we could see more rate cuts moving forward, and of course this would be result in further weakening of the rupiah. But rather than just a rate story, the big question is how fast will the fiscal guardrails around Indonesia unravel? There's been a lot of talk about whether the country will still, adhere to the 3% fiscal deficit ceiling that he has adhered to for the past few years or so. So I think something that investors are looking towards is that Indonesian Finance Minister Purbaya has a briefing with lawmakers later today, briefing them about the draft budget for 2026. So bearing in mind that that previously Mulyani set a target of 2.5% of a budget shortfall for next year. So there is a sense of jitteriness in the market about whether the new finance minister Purbaya will, the targets that he'll set for next year, and whether he will be, adhering to the 3% target.
Right. All right, Marcus, thank you. Marcus Wong there on the latest on EMFX. As we were talking about just now, we just got some Aussie job data numbers here, which didn't look too good, right? We're talking about jobs that were basically fell by 5,400. They're driven entirely by full-time roles, it seems, here right now, and really missing the mark. I think economists were expecting a 21,000 jobs that were supposed to be added here as well, but the unemployment rate did stay steady at 4.2%. But it seems like, given that, it does support the case for the RBA to remain cautious at this time when it comes to rate cuts here right now. But certainly, we are watching the Aussie dollar did actually fall on the back of that data.
Yeah, well, They never get it right anyway.
Never. Rarely.
So there's always a market. Oh, the algos are out again. Okay, plenty more ahead. This is the China Show.
All right. If you want to take a look at what AI can do, talk about Baidu, right? This is something that we really didn't talk about Baidu for months, even years, when it came to the AI train. There you go. Optimism over its AI chip, that potential that continues to grow here. So we're up another 3% after adding about $6 billion in a day in terms of market cap. But yeah, it seems like the calls to buy are getting louder.
Yeah, every time you look at this, if you sold when the stock was below 80, this is really a reminder of regrets, I guess, for many of those that, I guess, to some extent, said goodbye to that long trade here. On the chip story, so there's the Nvidia story, there's the self-sufficiency, there's the Goldman call. I think it was on Hua Hong, wasn't it?
Yes.
Yes, Qin Zhilao and the Goldman team, they're upgrading their price target on the stock to the mid-60s, I believe, 666. I could be mistaken, but from the current, of course, 57 where we are right now. So chips are on the way up. And this fundraising theme also continues very separately. You have Weimob and you have Dongfeng hitting the markets. I think it's about $1 billion each as far as Hong Kong dollars each as far as that share sale is concerned. And the city call on Maoyan.
Yeah, so they're talking when it comes to the holiday box office. Look at Maoyan as the main beneficiary here due to a lot of participation in the top 4 most popular movies during Golden Week. All right, we'll have more on the way in the next hour. You're watching The China Show. Welcome back to the China Show. A look at the CSI 300, a half hour into the session here right now, and we are seeing slightly to the downside here today. But yeah, keep in mind though, we also did get an upgrade when it comes to Goldman and their forecast when it comes to GDP for China now. So 2025 and 2026, they're saying now that growth rate now at 4.8% for 2025.
Yes. Okay, yeah. You know what? So they've revised the one for real GDP growth this year.
Yes.
By 1/10 to 4.8.
That's not much.
That's marginal. Andrew Tilton and Hui Shan. But yes, from 4.7, I believe, to 4.8%. And they've given a bit more context on why they did that. The upward revision to next year's forecast was driven by expectations of firmer exports. Okay, that's interesting too. And she's actually held that view.
She has.
Yeah, the exports were okay and will be okay.
Because they said when you go and compete and exports overseas, people still look at Chinese innovation and they see value in that and they're still going to buy, according to her. So the magnitude of growth deceleration appears not as large as assumed. That's what they're saying here right now. We're watching New Zealand assets, right? Because that GDP print was certainly a pretty ugly picture and really missed estimates there. So there you go. Now people, like the Westpac you mentioned, Dave, now forecasting a 50 basis point cut in October. Now you are seeing the Kiwi dollar as well as those yields moving in tandem.
Yeah. In fact, before we talk about that, I also want to mention, I don't think you guys saw it on your screens. Can we get a 2-year yield on New Zealand up, please? Because really, that is reflective of this. It's a similar story, by the way, in Indonesia. We'll talk about that in a moment, though. Reflective of the market catching up to pricing. The 2-year yield, please, if we can get that up, if we can. The ticker for that, for my producers, is GNZ2 index, check as rate. If we can get that up 12 basis points to the downside, reflective of the market catching up in terms of pricing to perhaps now more easing on the table here as it pertains to the RBNZ. That meeting, by the way, is October 7th, in case you need to mark your calendars there. Okay, now to Indonesia, where towards the latter part...
More surprises.
More surprises, right? Rate cut. I think we're now down 150 basis points.
Yep, and this is a really a central bank that I guess you could say is in favor of growth now. And on the back of all this political, instability, they're removing the finance minister and the like here. That do lead to some concerns about independence around the central bank. But certainly, what we're seeing is that by cutting by 25 basis points, that did catch a lot of forecasters by surprise. So. what that means for the rupiah, certainly we'll see what happens. But there you go. We're seeing some weakness there for the currency right now.
Okay, let's turn our attention back to the Fed conversation right now. And, so they moved 25. I think the takeaway that I got, at least from our conversation earlier on with Jack McIntyre, Brandywine, was it's certainly going to be data dependent. He doesn't think we're going to get a move below 4% until the next data point. And the pain trade, he says, will be a lowering of the long end yields, which I think it's really adding duration to this at this point in time is his key source of returns.
Yep. It's not a consensus call, I think, at this point.
Yeah.
But certainly there's a lot of questions about what came through in this meeting, right? Because, I mean, as expected, they did cut, also signaling 2 dots for the end of this year, which is slightly more than the previous projections. But then again, also, when it came to upgrading their inflation forecast, but also projecting more cuts, how they square those two things?
That sounds like stagflation. If you toss all that into a blender, the concept certainly comes up as well. But yeah, other things that Jay Powell mentioned, of course, pointed to signs of weakness in the labor market, to explain really why officials did what they did and how he framed what they did there. In fact, let's have a listen to how Jay Powell framed many of the key issues there.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Let's bring our senior markets editor and opinion columnist, John Authers. He's with us. So I know you were up watching this press briefing. I think jet lag helped with that front.
It did a bit, yes.
What stood out to you?
Reenacting Lost in Translation, yes.
Yeah, what stood out to you?
Sorry?
What stood out to you in this meeting?
Okay, the single most important thing, I'll say 2 things. The first is, given how much excitement and how much intensity there was over this meeting, if you actually look at where all the key markets were after the FOMC compared to a couple of hours before, it's one of the least eventful FOMC days in recent memory. The S&P 500 and the 2-year yield pretty much exactly where they were after some exciting gyrations. Ultimately, the market, I think, correctly buys this as being a more hawkish cut overall than was in the price because the dollar strengthened a bit and the 10-year yield has gone up.
Yeah.
The most important thing by a country mile, I can exclusively reveal my column is going to quote Sherlock Holmes, is the dog that didn't bark. There was only one dissent. There were 2 dissents last time before Stephen Mirren joined the committee, but this time around he was the only outlier. Now that's significant because the really critical point to understand whether we're going to get a fundamentally different Fed within the next 12 months or so is partly does Lisa Cook keep her job, which is a matter for the courts, and partly who gets the job of being the chairman. If you believe the prediction markets, Chris Waller, who was one of the dissenters last time, was the narrow favourite. He decided not to dissent, plainly must know that if he wants that job, and he's an ambitious man and it would be the pinnacle of his career to get it, he must know that it would have served him to dissent and ask for 50, and he didn't. If you believe the prediction markets, he is now neck and neck with Stephen Mirren for the job. If you want a market which completely turned upside down as though this was the biggest shock you can imagine, it was the betting markets for who gets the Fed job, which now is seen as being completely open with Stephen Mirren looking like he has a chance of getting the job. That was not something, even after he got nominated for the board, it was something like a 1-2% shot. So that is the big change. carrying on with, it sounds almost like Kremlinology, you know, how people used to look at which member of the Politburo was closest to the line of tanks in the Red Square parades. The other critical thing is who gets to choose the next round of governors. The argument has been, and this is where the Kremlinology comes in, is that if you fire Lisa Cook, then you have Stephen Mirren plus Mickey Bowman and Chris Waller, the two dissenters last time, plus Cook's replacement.
Yeah.
That gives you 4 of the 7 governors, and they can veto the people who are being put up for the FOMC from the regional feds. In the light of this, I'm not sure, not spoken to either Governor Waller or Governor Bowman about this. Perhaps some of that analysis has been a little unfair to them. I'm not sure that you can really assume that they're just going to choose anybody off the street who's got a MAGA hat to be on the FOMC if that's what they're being asked to do by the White House, which some of the analysis has suggested. It's a much more complicated picture, and really subjugating to the Fed to the White House is going to be trickier than it appeared.
What's interesting, right? So to your point, the markets almost didn't do anything.
Eventually, we had our normal FOMC day.
A normal FOMC day. The dollar sold off a little bit, but then quickly recovered.
Yeah.
What hasn't been mentioned, at least from you here, is where does the economy come into consideration as it pertains to monetary policy? So it seems as if the markets will now need to deal with an extra data point, which is looking at who makes up the FOMC.
Yes.
When does the economy also matter, I guess?
Okay.
Ironically.
No pun intended. Obviously, if there's a big deterioration in the economy, that trumps everything. And it actually gets the Fed to do what President Trump wants them to do.
Yeah. Maybe Waller also goes 50.
Yes. I think this has been overstated because claims data are noisy. The last claims data from last week suggested maybe there is a sharp deterioration going on. 3 or 4 numbers like that more, and you plainly have a Fed that needs to be far more dovish. You had a clip from and the fact that Jay Powell talked about the labour market in the way that he did. We are clearly somewhat more hawkish than people expected, but this is still plainly overall dovish. What he also said, and where he is perhaps minding his language slightly more carefully now that he has to sit around a table with Stephen Mirren, is on tariffs. There has been some pass-through. It hasn't been as fast and as great as expected. My personal belief is that we're probably going to get more. I think most governors of the Fed believe that as well.
More pass-through.
I think there will be more pass-through, and I'm not convinced, looking at some of the expectations data, consumer surveys, that it won't feed through into higher expectations. I think it behooves them not to talk about that, given how politicised the whole situation is at present, but that hasn't gone away either. So either inflation or unemployment breaking significantly upwards could really change the picture again. A Trump nominee is still not going to cut rates hugely if inflation goes back to 4%.
Powell mentioned he mentioned it's a risk management cut.
Yes.
Is that essentially an insurance cut?
Yes.
You think?
Yes. We're nervous enough about unemployment at this point, and we've given ourselves enough room for manoeuvre that we'll take a risk of making a cut when inflation is above target and trending in the wrong direction. But we will cut once and see how things develop over the next month as insurance against whether unemployment is as bad as it looks as though it might be. And I've just realised quite how many conditionals I put into that sentence. I think that was perhaps appropriate. It's not great prose, but that is what a conditional world we're living in.
But not quite aligned with what the market's pricing in. Maybe not as dovish. So there still needs to be some repricing, I think.
Correct.
Okay.
Correct.
Okay. John, it's great to have you. John Author's there.
Thank you.
He's been here all week with us. And, of course, John will be joining us later today, along with a panel of some of our leading Bloomberg journalists here for a special edition of the China Show. Yeah, we're going to sit down with AIA Group CIO Mark Conan to discuss where markets could be headed next under the second Trump administration.
Yeah, and it's a live version. effectively of what we do here on a daily basis. And, first, let me extend my gratitude to all of you, of course, who join us regularly. This event is exclusive to Bloomberg.com subscribers, but do not worry because you can catch the highlights from our conversation on the shows this time tomorrow. And if you haven't already, do make sure you subscribe so you do not miss the opportunity to see Yvonne live on set. Unfortunately, you're stuck with me as well. In-depth analysis, market insights coming. So lots to look forward to tonight going into the weekend.
And there's a newsletter that comes out every Thursday as well. But up next, the latest twist in the U.S.-China tech rivalry with Beijing's new clampdown on Nvidia chips. We have details coming up. This is Bloomberg.
Chip rally is continuing to give, and we can come up with 3 reasons here, but markets will come up with the 4th, really. That's just to say that the market has somewhat of a lower bar, which is not a bad thing, by the way, necessarily, to really keep on buying into this rally, whether that's liquidity, the news flow, whether that's all these announcements and pronouncements coming through out of the Chinese side of things, and whether or not the geopolitics continuing to drive, at least in this specific case today, domestic chip plays in China on the back of some news there, of course, out of China.
Yeah, China is widening its clampdown on Nvidia now, instructing domestic companies to halt orders for a particular workstation chip that can be repurposed for AI uses. Now, for the latest, let's bring in our chief North Asia correspondent, Stephen Ingle, on more of what we know about this so-called ban.
So, yes, this is first reported by the Financial Times and then corroborated by sources close to the story, essentially saying that the China Cyberspace Administration, the regulator of the Internet, essentially is instructing Chinese companies to not buy this, I guess you could call it a lower level HI chip from Nvidia, the RTX Pro 6000D. It's not the H20, which is a higher processing, but not the highest end. Obviously, it's not a Blackwell chip. Those are not allowed to be sold to China. The H20 has had a checkered history. Obviously, it's been put on the export control list by the U.S., then now is off, but then simultaneously, or thereafter, shortly thereafter, we saw China sort of instruct Chinese companies to hold off, not telling them, not instructing them, but basically encouraging them perhaps to hold off. And we've seen orders not go as high, obviously, as Jensen Huang would like, and they are counting on China. It's a bit of a tricky situation for Nvidia, obviously. Either they're caught up in geopolitics and some bargaining chips that China is trying to build up as negotiations are ongoing between China and the United States, as they work towards a possible summit between Xi and Trump. Everyone is trying to get leverage and find what kind of deliverables they're going to get. I'm not necessarily saying that is what's happening here, because the other side of the story could be China is increasingly confident in its own domestic chip making, as evidence of the story late yesterday by Bloomberg about Alibaba and getting a cornerstone customer in China Unicom for its T-head AI accelerator. So again, China's advancement in AI chips is advancing. Is it to the point where China is confident it doesn't need those chips necessarily from Nvidia? Because simultaneously to all this, we've also had the Ministry of Commerce announce 2 new probes into American chip curbs, and also those analog IC chips coming out. And they also saw this ruling just this week about Nvidia violating anti-monopoly laws with that 2020 purchase, $7 billion purchase of Mellanox technology. So there's been a lot of pressure from China on the U.S. chip making industries at a time when you would think China still needs those chips. Or do they? Right?
Yeah. I mean, they could be doing both things. Those 2 things are not, I guess, mutually exclusive.
Right. Could be happening simultaneously.
Simultaneously, right?
Sure.
Talk to us about the negotiations aspect. If this is, in fact, literally or figuratively a bargaining chip.
Well, you would expect China to try and get some sort of bargaining chip if they're going to come up with some sort of agreement that essentially ends the moratorium, the pause, if you will, the extension that expires on November 10th, and ahead of any kind of summit. And that could possibly be an area where China could then back off of some of this pressure that they're building up right now. But again, caught in the middle is Nvidia. this is what Jensen Huang had to say when he was asked about it in London on the sidelines of Trump's visit to the UK. He said, "I'm disappointed in what I see, but they, China, have larger agendas to work with between China and the United States. We certainly, what does he say there? We can only be in service of a market if the country wants us to be."
Yeah.
So he's obviously expressing some chagrin in the whole situation, but also resigned to the fact that there might be bigger geopolitics at play here.
Yeah, and we haven't even talked about Blackwell there and the prospects of that chip.
Blackwell's not going to be sold into China anytime soon, but the H20, we'll have to see if that can gain some traction.
Yeah, all right. Steve, thank you. Our Chief North Asia correspondent, Stephen Ingle there. Coming up, looking at another part of China tech, of course, we got Ellie Jiang from Macquarie Capital joining us to discuss all things tech. Meituan, Alibaba, she covers all of it. So she holds the lowest price target for Meituan, though, in the street on the stock here. So we'll ask her why. We've got plenty more ahead. This is Bloomberg. All right, we've been tracking our CGBs of late here. Certainly there's been a lot of talk about, is this sort of long bull run when it comes to CGBs fading now? But coming at a time when you actually are seeing some of the banks in China loading up on government debt at the fastest pace since 2019. Is it a risky time to be doing that? That's going to be a key question there.
Yeah, because you're effectively buying, you're increasingly sitting on an increasing number of assets that might be starting to lose value. And I think if you're looking at banks, then you mark to market. What happens then? You take a hit on financials. Of course, we're simply extrapolating what could happen here. But what we do know is, of course, Chinese banks have been loading up on government debt at the fastest pace in about 6 years, with commercial lenders raising their overall holdings by more than 20%. That's compared to last year. Let's bring in Iris Ouyang, of course, our FX and rates reporter, together here with us on set to talk us through the status of China's bond market. Why don't we start there with that question, Iris?
Thank you for having me, Yvonne and David. China's bond market has been very volatile in recent weeks, and it has been pressured by the stocks rally and Beijing's anti-involution efforts. But in the past two sections, we have been seeing that the bond prices already climbed. That's because we are seeing that some foreign funds and banks are buying the dip. So looking forward, we are still seeing there could be more demand in the market.
Can you tell us why? So why are Chinese banks buying more bonds now?
Yep. The first reason is that because there's sluggish demand in China, there is less loan demand from the corporates, consumers, and the real economy. So the banks need another source of revenue. So they are turning to the fixed income markets for more stable income. Actually, last year when China has the bond bull that outperforming global peers, one individual bond trader can earn millions of yuan in several months.
Yeah. I think we're showing this 3-year look at the Chinese. This is the Bloomberg benchmark of that as well. It's done very well to the point Iris was making, outperforming other global bond markets. So right now, at this point in time, what are bond investors going to be looking for now?
One element is that the people are watching for the PBOC resuming the bond trading that has been circulating in the market for weeks, and that has been supported the sentiment in recent days as well. So once the PBOC re-enter the markets, that could further support the sentiment. And the second thing is that people are waiting for potential more rate cuts by the PBOC. The market is now expecting one rate cut by the central bank in the fourth quarter.
Iris, thank you. Iris Ouyang there, our FX and rates reporter on, the CGB market here right now. In terms of the markets, we're watching very closely particular stocks here, some of these new consumption themes, right? Pop Mart certainly is one that we're watching out for because, we saw that wipeout just a few days ago, and now we're seeing a little bit of recovery there. Maybe because of what they saw from Morgan Stanley.
Yeah, I mean, value emerges when price drops as well. So Morgan Stanley out there with a note as far as this is concerned. LiDAR stocks is also a broader group that we're tracking today. And as you can see, of course, for one, we did get, of course, that big listing this week out of her side. Second reason we've been looking at this today in particular is this forecast, this report that does look and expect a pickup in demand as far as that's concerned going into 2026. Official CCTV report here that the LiDAR market is expected to reach 24 billion. That's renminbi this year. That's about double and almost double the year after that, so 2026 to 43.2 billion. Okay, one stock, of course, in Oz that we're tracking here today.
Santos. So we're dropping some close to 12% here right now. This is after a group led by Abu Dhabi National Oil. They actually walked away from that $19 billion takeover bid. So raising a lot of questions about what the next steps are going to be for Santos here, and of course the future of the CEO, Kevin Gallagher. So the share's down some 11%. Plenty more ahead. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are going to that lunch break here right now, and we are continuing to see a pretty good rally coming through in the Nikkei 225. We're up some 1% here right now. Dollar yen is just slightly below that 147 level here as well. Obviously, we've been talking about this sort of reemergence of dollar strength after that Jay Powell presser here. So, yes, so they did cut, but yes, a bit of caution moving forward.
Yeah, interesting price move on the dollar, on dollar yen specifically, right? So, Yvonne, you mentioned this pop in the U.S. dollar. It actually hit its head just above the 147 handle and then strengthened from that point in time. I guess the market's trying to, I don't want to say reprice to Fed expectations, but I mean, certainly there was an element of that when you look at the FX markets. And if you think the Fed actually gets to the terminal rate, which I think is now 2 more this year and 2 more next year, so that's 4 cuts priced. So we're closer to 125 now than we were closer to 150 cuts yesterday. So I think that was some of the minute changes as far as the Fed pricing is concerned. We also want to look at Japanese chip makers and semiconductors. I believe we have that coming up on your screens very shortly. So this rally we're seeing across the entire Asia-Pacific AI and chip space is playing out for different reasons. Of course, we talked about SK Hynix and HKBM in South Korea. There's obviously the cohort and what is this? Anyway, no, we're looking at Disco, Advantest, and all those things. Please, can we get that up if we can? And separately, of course, we're looking at that entire space in Hong Kong with Baidu and SenseTime. Baidu was up almost 20%. Well, at one point was up 20% yesterday. We're up a further 5% in the session today. Can we get Baidu up, guys? Hang Seng Tech is up, was up 2%. We're just coming off a little bit there. SenseTime was also a very big move to the upside yesterday, and we're up 5% still on the likes of Baidu. Plus, I think what's also encouraging is some of the news flow and commentary coming through out of JD.com and Meituan, which might be a separate strand to explore. But yes, Chinese tech has been doing very well, is an understatement.
Yeah, so JD talking, the chairman was saying they don't want to engage any more price wars when it comes to the hotel sector and the like. So, does this show us signs that maybe this price war in the food delivery, or at least that space, hotel space, is at least receding now? But certainly a lot of questions to ask when it comes to Ellie Jiang, head of Asia Internet and Software Research at Macquarie Capital. She joins us now from the bank's Asia Tech and Internet Conference. Ellie, it's great to have you. Let's start with the cloud space. I'll get to Meituan in a second, because it seems like all the rage right now this week has been about AI chips and cloud. There seems to be this whole self-reliance sort of theme that's going on here. I mean, how much more upside do you think that there are in some of these stocks now?
Well, when we talk about self-reliance, right, this is actually a huge topic. In fact, I think the definition here is a bit blurred. When we think about all of these hyperscalers, if you will, in China, I would say they're definitely still relying on different sources of the chips. Right? They're also working with different counterparties, from data centers to the enterprises, in order to get that end-to-end sort of digital infrastructure set up. The good thing about the Chinese hyperscalers is that they have been rooted within the enterprises across different industries for a very long time. right? So for the likes of Alibaba or Tencent or even Baidu and ByteDance, they are rooted into so many different industries, spanning across e-commerce, media, games, basically anything you can think of. So in other words, they're really just rooted into the day-to-day operations or even the lifestyles for the consumers and enterprises. And on that note, we are seeing the enterprises kind of embracing AI at a very rapid pace and like ever before. And partially because, obviously AI is bringing huge boost into the productivity side, but also the government is also putting pretty ambitious target saying that, they are hoping that China to become one of the key leaders for the AI race globally by 2030. Right? This is actually further echoed in their AI plus opinion draft that was released by the State Council. And it was actually a very encouraging tone seeing the government is, putting out more kind of granular details and targets for both the large platforms ecosystems as well as for the smaller industry players to, embrace AI from different perspectives. So coming back to the question of, how much further is this upside? I think the upside is definitely there, and it's actually being backed by both further revenue acceleration opportunities. This is obviously backed by strong demand and also boosted by very strong inflows coming back to China with investors in the market, putting higher hopes towards that further kind of longer term trajectory. So if we look at the broader sector, we remain very optimistic towards the opportunities, especially lying around these large internet platforms. We think they are in a very unique position to capture this rising opportunity.
Ellie, David here. Nice to see you. There's such a big gap, though, between where the market has already run to and where the business needs to be to narrow that gap. How do I need to be thinking about execution risk from a lot of these big platforms?
That's a fascinating question, David. I think if you think about the past, right, for a very long time, China or entire internet space has been trading at a distress multiple. I think during the worst times, we're talking about the internet sector trading at over 50% discount versus the US peers. And during that time, most of the investors actually would place the internet sector as a value sector. And people started to talk a lot more about cost savings, optimizations, even shareholder returns. On the current stage, shareholder returns still remains at a pretty important driver. But what's more exciting is we are seeing such AI demand and growth bringing physical, more tangible outcomes, right, to the companies. So from Baba's perspective, the Ali Cloud segment went from only low single-digit % revenue growth to 28% year-over-year increase in the past quarter. And we do see continued momentum for the cloud business into the second half of this year, likely to push the cloud revenue higher, right? All of that are already, delivering or translating into better confidence into the sector. So even at the current stage, after the sector itself has rallied so much, or the Hang Seng Tech Index has been, doing really well this year, I would say, if you're comparing that versus the likes in the U.S., the Western peers, we're still trading at a pretty meaningful discount. We're still talking about around 20 to 30% discount for majority of these large platforms. So I would say that the expectations have definitely gone up versus before, but we're still in the pretty rational zone.
Okay, rational. So I was going to get your recommendations. So Alibaba, you have an outperform rating. Baidu, which is also another hot stock this week on the whole AI trade, you still remain neutral. Can you walk us through the thinking behind those recommendations now?
Sure. I think I've already shared some thoughts towards the Alibaba, especially being the largest hyperscaler in China. Towards Baidu, this has been a huge topic for investors this week. We are having our tech conference in Hong Kong. Very excited to see, investors being very active and asking all sorts of questions across applications, agentic AIs, and SAMIs, and so on. Right? For Baidu, in the recent period of time, investors started to get much more excited about the hardware side, which is their self-developed Kunlun chip. That started to get much more demand and traction, right? Especially when you compare Baidu's valuation side by side with a lot of these kind of A-share hardware names. Now, I would say there's really limited information on the Kunlun chip itself, so it's very difficult for the market to put, a hard valuation or benchmark towards their relative, performance versus the other But what we know is we do acknowledge that there is embedded option values on Baidu at the current stage, given that the Kunlun chip does seem like to gain more market share among the domestic chip supplier. Overall, what's interesting is that we are noticing a higher diversity of supplies for domestic chips, and that has been echoed by the data centers. That's indicating there's very strong demand and even more tailwinds coming from the policy side to boost more domestic chip usage. So Baidu would be definitely one of the key beneficiaries. But at the same time, I guess the flip side of that argument is Baidu's core search remains heavily under pressure. So I think for investors, we always have to kind of debate the pros and cons. And of course, in Baidu's case, whether they are able to achieve kind of more of a stable stage for their search decline would be the key catalyst to watch out.
Ellie, maybe partly because of Alibaba, and correct us if we're wrong, that Alibaba has somewhat been seen as a big winner in its ability to apply AI to some of its businesses, and on the losing side of things have been the likes of Meituan, for example. So those two actually have been put head-to-head in the market. You have the lowest price target on the street on Meituan. Does the bear case still hold, and what would make you change your mind on the stock?
Yes, so we are quite bearish towards Meituan, and one of the key reason for the recent downgrade was that after the very shocking results, reported by Meituan in the second quarter, when their profit basically declined by over 90%, on an adjusted basis, I would say the recent change was more on the fact that Alibaba's navigation application, it's called AMAP, is now pushing further towards the in-store segment. The company actually announced that they are introducing more agentic AI features while introducing kind of the localized ranking features that's more based on the real-time data that's purely mapped by the consumers instead of kind of boosted by bidding or paying. Right? And the company actually said that they will not monetize such ranking feature in the near time or anytime soon. Which could potentially mean that we could see the shifting wallet share coming from the local merchants to kind of shift away from advertising on towards Meituan to the other services, including AMAP. Notably, AMAP is one of the largest consumer apps, right? I mean, of course, Baba, Taobao, Tencent still holds as the leaders, but we are seeing the consumers are using AMAP at a very high frequent pace, which pays very well for them to further tap into this high frequent consumer demand, especially in the local services. So we're just getting very worried about the in-store segment for Meituan, which is now the biggest contributor for the profitability.
And how do you see this competitive landscape changing, maybe for next year, Ellie? Obviously, Meituan is still the leader, I believe, in terms of market share, but it definitely is narrowing with Alibaba now.
Yeah, definitely. That's a great point. I would say at the current stage, we are seeing Baba very quickly catching up to the first player. Previously, we're talking about kind of a 75 versus 25 market split, right, for food delivery. At the current juncture, Baba is quickly catching up, and in terms of daily order volume, they're actually getting quite close to Meituan's current level. For in-store, it's a lot more fragmented. Of course, with Meituan being still the largest, but Douyin is also being, very sizable in terms of the GTV contributed. And if Alibaba started to, push AMAP further into the local side, then I would expect Alibaba to also take a very sizable market share within the in-store segment. So going forward, towards the medium term or even longer term, I would just say it's hard for us to put a fixed number, right, in terms of the market share, but let's just say it will be very certain or highly certain that the market itself will evolve into a multiplayer market.
Ellie, it's great to have you. Ellie Jiang there, head of Asia Internet and Software Research at Macquarie Capital, speaking from their conference there today. We have some lines here when it comes to Huawei. So according to a report from the Sci-Tech Innovation Board Daily, so they're talking about the company launching an Ascend 950 PR chips in the first quarter of next year. So they're announcing this plan for new AI chips through to 2028. This has been reported at the Huawei Connect conference here from the rotating chairman there. So that's the latest that we hear from there with Huawei and new chips. So more on the whole chip space data.
Yeah, it's almost every day there's a piece of news coming through here. Coming up here on shows, big interview in the next hour. So we talked about Trip.com and some of the potential regulatory hurdles, that's question mark, that they're facing right now out of market regulators in Zhengzhou over alleged unfair practices. Xiangshan, the CEO, joins shows later at those times on your screen. So that's in about, give or take, 30 minutes from now. This is Bloomberg.
Some of the stories that we're tracking for you today. Tesla says it's working on its redesign of its door handles following a Bloomberg investigation that uncovered incidents of people getting trapped in their vehicles. The firm's design chief told us Tesla is looking to combine the electronic and manual door release mechanisms, which are currently located separately. Earlier this week, the U.S. auto safety regulator opened an investigation into whether some Tesla doors are defective. Disney's ABC network is taking Jimmy Kimmel Live off the air immediately after a backlash over the late-night host's comments about the killing of Republican activist Charlie Kirk. On Monday, Kimmel suggested in his monologue that the man charged with Kirk's killing was a Trump supporter. A major owner of ABC TV affiliates, Nexstar Media, had called Kimmel's remarks offensive and insensitive.
Now, President Trump has begun his UK visit with a lavish state dinner hosted by King Charles and attended by the CEOs of Apple, Citi, Nvidia, Blackstone. We're all there. But the real business actually begins later Thursday when the president meets the Prime Minister, Keir Starmer. Our colleague Anne-Marie Hordern reports out of Windsor Castle.
It was a day fit for a king. President Donald Trump got the royal treatment in Windsor. The British royal family went above and beyond, even making little moments incredibly personal to the president, including a 1912 cognac at the state banquet representing the birth year of his Scottish-born mother. The president, during his remarks during the toast, wanted to emphasize the special relationship between the United States and the UK.
The word special does not begin to do it justice. We're like two notes in one chord or two verses of the same poem.
But that special relationship may get tense at the Prime Minister's country estate in Chequers. Keir Starmer and President Trump will have a bilateral meeting. Potentially the topics to be discussed: economic ties, the trade deal, the war in Gaza, the war in Ukraine, and potentially an awkward moment when it comes to the recently ousted British ambassador to the U.S., given his close ties to Jeffrey Epstein. Anne-Marie Hordern, Bloomberg News, Windsor.
And our subscribers can turn to your terminal for more on this. TL Vigo is effectively the platform you run, and you get into this, of course, ahead of the Thursday where the real business begins. Commentary, context, and analysis going into this big event coming through later today. It also just so happens, of course, there's a Bank of England rate decision to also contend with when you look at that. Plenty more ahead. This is Bloomberg.
Our Indonesian markets are doing this here right now. So we are seeing slight gains in the equity markets, some weakness in the currency here today because it was interesting, right? That surprise cut from Bank Indonesia here on Wednesday, which really kind of took the market off guard there, but signaling this kind of all-in push to growth now and really kind of sidelining the rupiah and the vulnerabilities behind that here as well. So certainly that's one thing to watch. And the bank sector, a mixed picture here right now on the back of that surprise move.
Yeah, fairly big constituent and, of course, waiting there as far as the benchmark is concerned. Certainly the move, as Yvonne is pointing out, maybe is meant to galvanize growth following the recent cost of living protests, of course, have been really front and center as far as the Indonesian story is concerned there. Let's bring in Ramsey Al-Rikabi, of course, who leads our Southeast Asia economics and government coverage, joining us right now to help us understand. Ramsey, so clearly, might be fair to say that the economic case for a cut wasn't as clear-cut, given how most economists did not see this coming. But the bigger context is what here, Ramsey?
Hey guys, good morning. I think the bigger context is President Prabowo's influence and extending his grip on power across the levers of government. Now, Bank Indonesia already has a mandate to sort of work with the government and the finance ministry to sustain growth. But what we saw yesterday, as you mentioned, was a surprise cut, the second surprise cut in a row of their interest rates. And the central bank governor leaned in very heavily to what I believe he called the all-out pro-growth strategy to drive GDP higher. And keep in mind that comes after a week ago, President Prabowo dismissed the finance minister and brought in someone who also believes in an aggressive effort to push growth. And as you mentioned, amid that anger, public anger, and the hope to basically drive the economy higher and bring in higher revenues and to use that money for Prabowo's major food and housing and health programs for the population.
Yeah, so it is a tilt towards growth here, Ramsey. What does this mean for the currency? It seems like they're sidelining the currency in some ways, and the rupee already one of the worst performing currencies in Asia this month.
That's right. Do keep in mind that the central bank did say that they will keep an eye on currency stability. They see inflation fairly low, which I think they see gives them room for these cuts. But you're right, it is one of the worst performers in Asia. It is though we see many rising because of the weakening dollar. But I don't think they've gone so far as say they're not concerned so much about the currency. They do keep one eye on it. They have intervened recently during the protests and other disruptions, including Indrawati's dismissal. So they're definitely watching it. They're trying to. They intervene to keep it stabilized. But as you mentioned, and as the central bank has really made clear, that it's all growth almost all the time now for those guys.
Ramsey, fantastic. Thank you so much, sir. Ramsey Al-Rikabi there, who leads our Southeast Asia government and economics coverage. Before we just wrap the show up, just a glance at some of the big movers across these markets. We'll just pivot away from China just for a second here to look at Samsung, of course, and another massive gain here on the stock, 2.3%. And the news here, 60,000 new staff, of course. That's over the next 5 years. Speaking of just the whole growth conversation we've had here in the last few minutes or so. Staying in chips and tech, but we're pivoting back to China and some of the upgrades coming through here on Goldman and Huawei, and the chip rally continuing there. We're up 11.5% on Huawei semi-upgraded there, as we were pointing out at Goldman, based on, I guess, some of the business dynamics and pricing dynamics as far as that one is concerned. Okay, one stock that has been very much in focus this week has been, we were asking about to see Alibaba, but Baidu has now taken, I think, in some extent, much of that spotlight. And why not, following a 20% at one point yesterday and another 5% today?
Yeah, it's nuts. But Macquarie's Ellie did tell us, right? It all depends on whether they can stabilize the slowing of what they're seeing in the ad business, right? Yeah. And the search and the like. So that certainly still is the core, I think, the concern. But certainly they're still needing some more, clarity and maybe details of this whole Kunlun chip as well, according to her. That's why she remains neutral on the stock for now.
Yeah, there we go. And of course, PopMart, Morgan Stanley coming out with a note here, fairly encouraging one here on Labubu.
There's supply, and it shouldn't be seen as a sign of weak demand, but more IP visibility and more chance for more people to get their hands on some Labubus than like.
Yeah, more cute stuff hanging from your handbag.
Expand the customer base, yes. Introduce more people to buy.
All right, that's it from us. We will see you all tomorrow as this rally has now somewhat petered out, and the Hang Seng HS Tech, though, is still up for a 5th straight day.